afternoon, everyone, and welcome to Stock Market Today. You have Alyssa Corman, Ed Carson here, breaking down the market action and some names underneath the surface as well, Ed. And we're going to do a little bit of a different spin on the show today, just to, I guess, underscore the weak action that we're seeing right now by looking at a bunch of different ETFs too.
Yeah, we're going to take a look at a bunch of ETFs that show the rotation and the weakness in that. And we're also going to take a look at Applied Materials and Tencent Music.
All right, let's do it. First, a look at the major indexes, kicking things off with the NASDAQ, which dropped 2% today, closing below that key round number of 13,000. We also had the S&P 500 down about 0.6%. Small caps taking another big hit today, Ed. The Russell down 1.9% and the Dow closing roughly flat. So holding up a little bit better. We'll check in on these different indexes. But first with the NASDAQ, I mean, we've said that the Nasdaq's been lagging, really wanted to see it not only get back above that 50-day line, but also some of those recent highs here as well. And now we're further away from that and below a key round number.
Yeah, really weak action, closing at the lows. All the indexes, basically the lows of the day. NASDAQ undercutting some recent lows. I think it's the lowest close since the record close, not record close, but the sort of the correction close down there. It's just really weak action there, and we didn't see a whole lot much good elsewhere as well.
Well, the Dow did hold up a little bit better today. Here's the Spider Dow Jones ETF, but it too is pulling back after a big move off of this touch of the 50-day here.
Yeah, I mean, in the morning it looked like, okay, the techs are weak, but some of these commodity travel plays are bouncing back. But they basically fizzled. And even at the highs of the day, it had given up some of the days of the prior days. I mean, if you had bought on breakouts that sort of were Dow type names, even at the high of the day, you were still down for a few days, whereas growth stocks were getting hammered. I mean, it's not an environment to be making money. I mean, honestly, for any kind of investor in the last few weeks.
Yeah, well, let's take a look also just really quickly at the S&P 500. Closing below its 21-day line. That's an area that it's been testing this week and now closing below that level and is getting pretty darn close to that 50-day too.
Yeah, that would be a really bad sign if it goes below the 50-day line with the NASDAQ already below it and the Russell 2000 not faring any better.
Yeah, speaking of the Russell taking a really hard hit, I mean, round tripping all of the momentum that it had off of that upside reversal off of the 50-day line. So continuing to deteriorate these small caps as well, which it looked like we had just seen a pivot to strengthen that area.
Yeah, Justin, it's like if you ever, it's sort of like switching car lanes in the highway, whatever's moving, I get over it. And that's the moment it freezes up. The reason why this analogy doesn't work is that no matter how bad it is, you'll probably get home with rush hour. You may not getting home with these stocks. You may end up going in reverse. So it's just been a really tricky situation, end up buying near the tops and then getting hit with stop losses along the way. Just really difficult trading.
Which is exactly why when we've talked about always, whenever you buy a stock, you need to have that a stop in place because just because the fundamentals are there, the technicals are there, that it has a picture perfect breakout doesn't guarantee success with the trade because overall market conditions can really have an impact on things.
Yeah, that's absolutely true.
And now let's take a look at a variety of ETFs, just really underscoring the weak action here. FFTY, the Innovator IBD 50 ETF, which tracks growth stocks. So this ETF took a huge hit today, Ed.
Yeah,
What do you
really
think?
ugly. 2 days ago, this was looking okay. It was holding above the 50-day line, not so bad. And then whoosh, it didn't take any time at all. So right in there, you were thinking, oh, one good day, and it almost would look like a breaking of a downtrend, a buy signal, but no, now it's not. I mean, it's just that's what it comes down to, two really bad days, and it looks terrible.
And ARKK from ARK Invest. We know a lot of growth investors have been following Cathie Wood's moves very, very closely. This ETF had huge performance in 2020, but got hit extremely hard in the last sell-off, hasn't really made up much ground, and got slammed back down again today.
Yeah, I mean, whereas the IBD 50 index is sort of a growth stock index, this one is more of the speculative, highly valued growth stocks, and those were great. But Tesla, Teladoc, all those stocks, they're really damaged. I mean, that's just the way it is, and so this ETF reflects that, and there really isn't much to be said until those stocks get, till that kind of sector can get above the 21-day line, get above the recent highs, get above the 50-day line. You pretty much just want to put that to the side.
Yeah, a simple saying that is said quite often: the trend is your friend. That's why we don't like buying against the market tide, even though it might be tempting to think, wow, something like this is on sale. We want to put the odds in our favor, and when you see things heading south in a big way like they are here, that's not the time that you want to be wading into those waters. And XME, yet another one, metals and mining, a number of names in those groups. We were seeing some encouraging action, but what do you make of the action here as it stands now?
Yeah, sort of like the Dow, like even at the intraday highs, it was only getting some of the prior day's losses. You can see it had been retreating, and that's not a trade-off. If you have half tech and half cyclicals, that wouldn't have been a good trade-off. But then to have it come right down to the bottom, it's hitting support again. Yeah, it's at the 50-day line right now, but that's really discouraging with that decline. The recent trend has been weak there. We're going from mixed to sort of like generally weak, on a lot of these things. That is just not encouraging. Just trying to emphasize the point. Things aren't going well. You own stocks in almost any of these sectors, and they're probably going down.
Yeah, growth, speculative, industrials, and the reopening play. Jets here. So even there's this reopening play, at least this area of it, deteriorating as well.
Yeah, and again, if you own some of these things from way further back, that's different. If you hold long-term positions, you want to hold some stocks or a couple of ETFs, that you have long-term positions, that's different. But,
Mm-hmm.
this reflective, all the airlines, all those hotel stocks, all the ones that were moving the last couple of weeks, they've probably given up those gains. And that's just the way the market is acting right now.
And we saw a pretty big move in the early going for Applied Materials in the semiconductor equipment group. This is a name that we had been watching as it looked like it was ready to go and clear this downward sloping trend line that we have here, which coincided with the 120 level, but had a really weak close today.
Yeah, this was the one chip gear maker that was sort of holding up. All the chip gear makers were rallying because Intel announced last night, we're going to spend $20 billion on chip plants. We're going to do all this stuff. And so it's a lot of equipment that, Applied Materials and others are going to sell to Intel. This was holding up reasonably well until just the last few minutes. It was off the highs, but you can see how it just fell off. And this was the whole NASDAQ, so there's nothing unusual about it. I mean, look, and you also don't know the next day if techs are going to fall. Sometimes when you have good news for a day off of earnings or some news, you get that pop, and then it just starts acting like everything else. So if the market continues to fade, this will fade. You definitely want to pay attention to this stock and these chip gear makers, because a lot of them are the ones that, if the market turns around, they look like they're setting up. The RS line is right at a new high. It really was in a new high ground earlier today, but in this environment, even the best stocks are going to struggle.
And Arusha was saying this morning when we were taking a look at this, when he was looking pretty interesting, that you might want to wait till the end of the day because of the overall market conditions. And here we have Applied Materials not able to hold up super well. And let's also take a look at TME. A pretty shocking plunge to the eye here, Ed, down 27%. TME was a standout among China stocks as of late, showing really strong technical action, but a very damaging move today to the stock.
Yeah, this is when you probably didn't want to wait till the end of the day, because while IBD Live was going
Maybe
on,
wait to buy, but not to sell.
yeah, not to sell, because it had already erased the buy, the breakout.
Yeah.
Whatever buy point you wanted to use, it was gone by that area, or even the little early entry maybe there. It was down there by the time it was like 8 o'clock or so. There didn't seem to be anything fundamentally going on per se. They had earnings a couple days ago. They did fine. Stock held up fine during that, but China stocks got hammered today. There was some variety of news. Internet companies are going to have to share perhaps more of their data with maybe the government in some kind of sort of official joint ventures. There was some China central bank seems to be pulling back some of the liquidity, so maybe less for the asset prices. So a lot of China stocks got hammered, but boy, this was really tough. This is why you have to be alert. It's really unfortunate. Sometimes you can get caught out. You go out and have breakfast, like if you're not 100% but you got to get out of those things because this was really, really ugly action. And it just shows you how there's lots of ways the market can get you. This is the scariest, but it's getting you.
Yes, always want to have that exit strategy in place when you buy. And I think it also shows that we've been saying in this market, even with the pockets of strength that we've had in this bifurcated market, it hasn't really felt like the time to be super aggressive. We've been saying maybe have smaller positions, don't take on a lot of risk, have those tight stops in place. But today feels like a different change in the tone in the broad market conditions.
It really felt weak, and you're seeing the breakouts failing just more and more, and it's just continuing that way. And it's just, if you're, even if you didn't pay any attention to the market, if you're watching your stocks and you're seeing them come in, that should be telling you. But the major indexes, they're all coming in. There's no real strength in the market. There's sort of a lack of leadership. It's just about which stocks are going to get hit today and which might have a modest gain, but not real leadership. Look, in a few weeks, in a few months, we're going to have a great market again, or maybe at least a good market again. There's no reason to just try to fight and maybe to get a 1% gain when the risk is there that you'll get 10, 15% losses. So you just want to be cautious in this environment.
Yeah, wise words there, Ed. Thanks so much for that. And thank you all for tuning in. We're going to continue the discussion tomorrow morning on IBD Live. So we hope you join us.
March 24, 2020 Market Commentary. March 24, 2021. Wall Street closed in the red on Wednesday amid a sharp decline in tech shares, as the market rotation out of growth names continued. On the pandemic side, the WHO warned that many regions are seeing rises in COVID-19 contagions, with Germany, France, Chile, and Brazil enforcing stricter lockdowns. On the macro side, oil prices rebounded 6% and boosted share prices in the energy sector, while the 10-year Treasury yield held steady at around 1.64%. The Dow Jones lost 2 points or less than 0.1% to 32,421. The S&P 500 shed 21 points or 0.6% to 3889. The Nasdaq 266 points or 2% to 12,962. The yield on the benchmark 10-year Treasury note edged higher to 1.64% on Wednesday after touching 1.59% early in the session as investors digest Fed Chair comments during his second appearance before Congress this week. Powell persistently played down inflation risks and higher yields and reiterated the U.S. economic recovery is strengthening but remains far from complete. The 10-year yield remains below 14-month highs of 1.75% reached in the previous week. Meanwhile, traders await several Treasury auctions during the week to see if demand remains strong. The 2-year auction saw solid demand, but foreign buyers declined, while a sale of benchmark 10-year notes earlier in the month drew solid international demand. Other offerings this week include 7-year and 5-year notes. Oil prices jumped more than 5% on Wednesday, after falling to an over 1-month low in the previous session on supply concerns after container ship ran aground and blocked the Suez Canal and several attempts to refloat it have failed. However, sentiment remains bearish amid rising U.S. crude inventories and growing concerns about demand recovery in the wake of new pandemic curbs in Europe. WTI crude is down more than 12% since hitting its highest since October 2018 at $67.98 on March 8, as a new wave of coronavirus infections across Europe dampen expectations of an imminent recovery in fuel demand. Latest EIA data showed stocks of crude oil in the U.S. rose by 1.912 million barrels in the week ended March 19, the fifth consecutive week of increases. In the New York morning trading, WTI was trading around $60.90 a barrel and Brent about $64 a barrel. The IHS Markit US Composite PMI posted 59.1 in March of 2021, down slightly from 59.5 in February, to signal the second fastest private sector upturn for 6 years, a preliminary estimate showed. Although capacity pressures stemming from extensive supply shortages constrained manufacturing output growth to the slowest for 5 months, goods producers reported the sharpest rise in new orders since June 2014. Service providers meanwhile recorded the steepest increase in new business for almost 3 years amid stronger client demand and looser coronavirus disease 2019 restrictions. The combined increase in manufacturing and service sector new orders was the strongest since September 2014. Business confidence picked up in March, running at a level rarely exceeded over the past 7 years. The IHS Markit Flash US Manufacturing PMI edged up to 59 in March of 2021 from 58.6 in February, slightly below market forecasts of 59.3. The improvement in operating conditions was the second fastest since April 2010 amid stronger client demand, but data also highlighted the most severe supply chain disruption on record. Sustained deteriorations in vendor performance noticeably impacted manufacturing production capacity, due to a lack of raw materials to fulfill new orders. The upturn in new business accelerated to the sharpest since June 2014 while job creation eased slightly. Amid substantial supplier shortages and input delays, manufacturing firms registered the fastest rise in input costs for a decade and the rate of charge inflation the sharpest on record. Finally, business confidence remained historically upbeat, as firms expect output to rise over the coming year amid stronger new order inflows and hopes of an end to the pandemic. The IHS Markit US Services PMI rose to 60 in March of 2021 from 58.8 in February, and in line with market expectations, a preliminary estimate showed. The latest reading pointed to the strongest expansion in the service sector since July 2014. New orders rose sharply amid stronger client demand and the loosening of COVID-19 restrictions in some states. Moreover, the increase in total new sales was supported by a renewed expansion in new export orders. The rate of input price inflation was the sharpest since data collection began in late 2009. Firms were able to partially pass higher costs through to clients, however, as selling prices rose at the fastest pace on record. Greater new business led firms to expand employment in March and at the quickest pace since December 2020. Business confidence picked up as service providers were buoyed by stronger client demand and hopes of a return to normal business operations amid expectations that COVID-19 restrictions will loosen throughout 2021. Mortgage applications in the U.S. fell 2.5% in the week ended March 19, 2021, the third consecutive decline, mainly due to a 5.1% fall in home refinancing as higher mortgage rates started to dent the market. Meanwhile, applications to purchase a home rose 2.6%. Purchase applications were strong over the week, driven both by households seeking more living space and younger households looking to enter homeownership, said Joel Kahn, an MBA economist. The average purchase loan balance increased again, both by quickening home price growth and a rise in higher balance conventional applications. The average interest rate for 30-year fixed-rate mortgages increased to 3.36% from 3.28%, the highest since the beginning of June. Gold edged up to $1,730 an ounce on Wednesday, as Treasury yields continue to retreat and concerns about a slower global economic recovery amid rising coronavirus and restrictions in many countries lifted demand for the safe haven metal. However, bullion's attraction is still limited by a stronger dollar. Federal Reserve Jerome Powell played down the risk that a rise in prices this year would spur unwanted inflation, while U.S. Treasury Secretary Janet Yellen said future tax hikes will be needed to pay for infrastructure projects and other public investments. Silver traded higher above $25 an ounce on Wednesday, despite a stronger dollar and falling Treasury yields, as investors remain concerned over slower global growth amid rising coronavirus infections and renewed restrictions in many countries. LME copper futures were trading around $4 per pound, a level not seen in 2 weeks, as a stronger dollar, sanctions between China and the West, and new coronavirus lockdowns in Europe rattled sentiment. Investors grew concerned about a surge in COVID-19 cases and a sluggish vaccination campaign in Europe, which led to fresh lockdowns and delayed expectations of a global economic rebound. Still, upbeat data from top metals consumer China has capped much of the downward momentum. The Chinese factory and retail sector activity surged in the first 2 months of 2021, easily beating market expectations, as the economy consolidated its recovery from the coronavirus blow. The commodity, considered an economic barometer, has been in a massive rally from its March's multi-year lows on the back of unprecedented measures from central banks and governments to shore up economic growth. Shanghai steel futures were trading around the 4,700 yuan a ton level in the aftermath of production curbs after top steelmaking city Tangshan pledged to cut emissions by 50% during days of heavy pollution. Still, the fundamentals have not changed, with strong domestic demand, mainly due to China's massive spending on infrastructure construction, expected to push prices higher. China's property and infrastructure investment surged 38.3% and 36.6%, respectively, in the first 2 months of 2021 as the economy consolidated its recovery from the coronavirus blow. The Baltic Dry Index fell 3.4% to 2,194 on Wednesday, its lowest since March 17, and extending losses for a second session. The Panamax Index, which measures coal or grain cargoes, slumped 4.2% to 2,858, and the Capesize Index, which tracks iron ore and coal cargoes, declined 3.9% to 2,215. Among smaller vessels, the Supramax Index fell 42 points to 2,084. European stocks cut losses to close mostly higher on Wednesday, amid strong preliminary PMI's data, and as Germany cancels a 5-day hard lockdown over Easter. Manufacturing output growth hit a record high in both the euro area and Germany, and France's factory sector expanded the most since January 2018. Also, services activity unexpectedly returned to growth in Germany and fell less than expected in both the Eurozone and France. Meantime, investors remained concerned that rising coronavirus infections and lockdowns could delay an already tepid economic recovery in the continent despite strong preliminary PMI's data. The Netherlands joined Germany, France, and many other countries on the continent and extended the curfew by 3 more weeks. Frankfurt's DAX 30 edged down while other major indices gained between 0.1% and 0.7%. The Shanghai Composite fell 44.45 points, or 1.3% to 3,367.06 on Wednesday, nearing fresh 4-month lows amid concerns of potential rate hike and policy tightening globally, while elevated U.S. Treasury yields also dampened risk appetite. In addition, an increase in COVID-19 cases reignited concerns about global recovery. On the diplomatic front, China on Tuesday threatened retaliation against the U.S. over sanctions that targeted Beijing's human rights abuses in Xinjiang. In Hong Kong, the Hang Seng Index fell 656.19 points, or 2.3%, extending to 10-week lows of 27,841.19. Among individual stocks, Kuaishou Technology slumped 12.48% after the company's losses widened to $2.9 billion due to higher operating expenses, while Tencent fell 1.59%, ahead of its earnings report. The Nikkei 225 was down 590.4 points, or 2.04% to 28,405.52 on Wednesday, falling for the 4th consecutive session amid growing concerns about the pace of the global economic recovery after the return of coronavirus lockdowns in Europe and declining oil prices dented risk appetite. Meantime, the Bank of Japan minutes showed that policymakers agreed to ease without hesitation if needed, with eyes on a pandemic fallout on the economy. Governor Haruhiko Kuroda also noted that the central bank had no plan now to start selling its massive holdings of exchange-traded funds after removing its $55 billion annual target for ETF purchases and halting the purchases of Nikkei 225 ETFs for the first time in a decade. On the data front, Japan manufacturing PMI in March rose to a 27-month high, while the service sector grew the most in 3 months. Thank you, and please stay tuned for more upcoming reports. Institutional investors, be sure to visit my website to subscribe and ask for a free copy of the Bull Valley Advisor Stock Market Newsletter. www.bullvalleyadvisors.com. You can also subscribe and listen to my podcasts on Anchor at anchor.fm/Len-Martinez-PhD-CPA. You can also subscribe and listen to my podcasts on Google Podcasts, Apple Podcasts, Breaker, Radio Public, and Spotify. Len Martinez is a financial consultant. Information in the Bull Valley Advisor newsletter should not be considered as investment advice or an offer to buy or sell securities. Data is derived from sources considered to be reliable, including Morningstar, StockCharts.com, Yahoo Finance, Finviz, TipRanks, Investing.com, ECRI, OECD, Guru Focus, Crestmont Research, Trading Economics, and S2O. Results are not guaranteed. Len Martinez is not an RIA. The data is shown for informational purposes and should not be considered investment advice or an offer to buy or sell securities.